All right, everybody. Looks like we are live on YouTube, X, and Twitch. Have a good evening so far. Sunday, May 18th, 2025. Been 10 days since our last episode on Cashflow Chronicles. A lot has happened. We've seen some ups, some downs, but overall, things are looking good. Excited to be here with Mr. Patel. As always, let's do a quick rundown of the markets as they are today. We have the S&P 500 back close to all-time highs, but we'll touch on that in just a second. We have Apple back above $200. We're at 207.94. Amazon at 202. Dutch Bros above $72 before the close last week. Google at 163. Palantir 125. Rocket Lab is a new one that we've added to the ticker symbol, 2470. SPY just below 5,900. The Q's 514. Bitcoin trying to hit 106. Oil back above, back up 5% from last when we checked in $60.47. Henry Hub $3.25. Man, it's been fun. How are things going with you? How's the portfolio? What do we do? Is this emergency meeting about VG? What are we doing today?
No, man. We're at a point right now where the administration's back into its back and forth again with strategic uncertainty. I was watching this interview with Jake Tapper today with Scott Bessington, and he was basically like, well, now that we are where we are, we might be like looking to put tariffs back on again on certain countries. And I'm just like, oh God, here we go again. So right now the markets, and you can see the futures are down. It's just not to mention we've got issues in Congress with the big, beautiful bill failing to pass, primarily because there's a combination of two things happening. You've got a lot of red, like blue state Republicans that want to get the SALT cap deduction lifted significantly, and that would add to, once again, to the deficit. So a lot of the first Trump tax cuts, a lot of them were backed on a limit of how much people could deduct from their taxes when it came to paying their state and local taxes. So, if you go to like New York, and if you're from Long Island, your property taxes could be like 20,000, your income taxes, because New York State has a 8.5, and then New York City has another tax on there. You get like almost 10-12% on there. So if you're making, let's say, 150,000, which isn't unusual for someone in New York City, you're going to be paying almost 30-40,000 in state and local taxes. And before, you could write off the entire amount. Now you can only write off 10. So a lot of these people, they want to extend it to much, much higher levels. And they, believe it or not, they are holding things hostage for the other part of the Republican Party. And so we're in another portion of this back and forth negotiating. The Democrats, of course, are loving it. They're just like, look, these guys are tearing each other apart. This is good for us. And just the country's fiscal order is, the fiscal health is in poor shape. So we've got Republicans that are always like tax cuts, tax cuts, tax cuts. And you've got the Democrats, which are like, let's keep doing social spending, social spending, social spending. And both sides are basically all about, let's just blow up this deficit as much as we can. And so the baser instincts of both parties, instead of agreeing to, the long-term future health of the country, they're more concerned about their next reelection, and so they're acting upon that. And that's where we are today. This is one of the challenges that happens with democracies. The good thing is typically when shit hits the fan, everyone tends to react, in the right direction, but shit has to hit the fan. Mm-hmm. And unfortunately, we're headed in a not so good direction right now.
Do you think the Moody's downgrade from AAA to AA3 will kind of kick the government in the pants a little bit and allow them to kind of rally behind this, you think, and maybe start, hey, I know it's happened a couple times now over the past decade, but is this an opportunity for them to say, oh shit, if we don't get our act together, this might be the precipice of a continued downgrade over time in the next several years. And we need to really band together rather than being at each other's throats like we have been.
Yeah, I mean, when you have a president who's very divisive. Look, President Trump, for all what he is a very divisive president. But even he has certain tendencies to move in the center. I just hope that the parties can do the same. Like, here's an example: the Trump administration came out and said, "Look, we're looking to cut Medicaid and all of these things in this big, beautiful tax bill, which is fine." But one of the offset was, hey, let's kind of raise the marginal tax rate on the super wealthy by a few percentage points to help pay for some of that. And there's like a wing of the Republican party that are clearly bought by special interest. They were like, oh, no, we can't do that. We cannot. And it was some crazy figure too. It was like something around 2.5 million, right? So it wasn't like, oh, the average person who's making a couple of 100,000, even like upper middle class, is the one that's going to be impacted. It was someone who's making like 2.5 million and above. So like they would get taxes on them go a little bit higher. And it wasn't like crazy amount either. It was like 3% or something, but they were like, no. And this is, like I said, this is where we are with the politics. And I don't know. I hope that some sort of agreement comes to pass that allows us to get past all of this stuff. The bond market is reacting very poorly to all of this stuff, which is even a bigger problem. So if you look at the long end of the curve, the 30-year treasury is close to 5% again. The 10-year treasury is, I think it's over 4.5 or at least close to it. So the challenge is, the worse you are as a creditor, the more you have to pay in interest. And the more you keep spending, the higher the interest will go, because people are not going to trust you. People are going to say, oh, this country can't even run its fiscal house in order. So we've got a challenge, and the thing is, the politicians, I don't know what's going on in Congress. Like I said, they're too busy fighting each other to figure this out in a meaningful way. And that's just where we are.
Interesting. So what do you think the follow-on impact of this? Do you think this is going to really get Jerome Powell kind of in a bind and really going to have to start to cut rates, or what's the deal?
I mean, he's got everything working towards cutting interest rates. Like everything, like in terms of the economy is like inflation expectations are rising. But if you look at the actual data, inflation is not that bad. It's pretty close to their target. But once again, Jerome Powell is caught between independence of the Fed and a president who talks too much. Like right now, the President Trump is constantly saying like, oh, Jerome needs to cut interest rates. And the thing is, you need this independence of the Fed thing, because the last thing you want is politicians controlling the monetary policy, because they have a tendency to always go the easy route, right? It's I was like, oh, you know what? It's politically convenient to spend as much money because this way everyone is happy. But the problem is you're stealing from the future, and reasonable people understand that. They said, look, if right now we spend all of our money and future money, because that's what you're essentially doing, on either social programs or giant tax cuts, we're going to be in a position where you're going to basically make the future worse. So if you look at our total national debt and national debt to GDP, like literally going back 20 years, we've blown up our debt, and how do we blow up our debt? Because we just didn't want to accept the fact that we need to control our spending 20 years ago. And instead, we just kept spending. And even right now, like the Trump administration is planning on spending $1 trillion on the military when we're not at war with anyone. Then we're spending $1 trillion on Medicaid, another $1 trillion on Medicare. So it doesn't, and I think the interest is going to be almost like 1.2 trillion. So, so our total, like our budget deficit is extremely large, and instead of addressing it, we're letting things go. And so now, Jerome Powell cannot come to the rescue over bad policy. Like this is bad policy. Jerome Powell has no ability to control that. Jerome Powell can't go to President Biden and said, look, you're spending too much money. This IRA thing is stupid. He didn't have the power. All he could do is raise interest rates. And I'm sure that when Jerome Powell was raising interest rates during the Biden administration, it wasn't a popular thing, but he had to be done, right? So that's where we are with the Trump administration, where, you know, inflation is almost dead. And Jerome Powell's like, look, he probably is thinking to himself, like, I want to cut. But the more this guy mouths off, the more likely it is. And these tariffs, the more he proposes these tariffs, the more likely it is that we do end up getting inflation. And then that ends up causing a second round of BS. So there are so many things working in the background. I wonder what the strategy with Scott Bessent is actually. Like, these are like shadowy things to try to figure out. Like, do they actually have a plan, or are they just shooting from the hip as the next crisis comes along?
So I don't disagree with you with respect to the deficit, obviously being, you know, probably close to $1 trillion, and then obviously the mounting debt and how we've been increasingly going into debt over the past 20, 30 years. So I can't disagree with you at all with respect to that. But to me, you look at all the rest of the countries in the world, and you could say, exactly taking what you stated, you could take one or two things from that and say, okay, well, all the other countries in the world have been cutting, right? Maybe it is the fact that they're taking the easy way out, as you stated, and they're saying, you know what, this is what's going to be popular because we raised interest rates the fastest we've had, potentially, at least in recent history for sure, and at maybe even ever, at the pace at which they did. So let's loosen the collar a little bit, and then we can kind of play with what's going on, you know, going forward. Or it's maybe the United States is taking the appropriate route and not cutting rates, and Jerome is correct to be holding on a little bit longer than everybody else, because everyone else is taking that easy way out. I don't necessarily know. You know, I'm not some sort of economist, but what I can say is I still think, even though we've raised interest rates in the fastest rate possible over the past 2.5, 3 years, in my opinion, the economy is still very strong, regardless of whether or not you think, oh, well, you know, you can really pinpoint certain parts within the economy to say this isn't going well, or we're having a shitty time of it, and things aren't going to the smoothness at which they could. Given the circumstance of raising interest rates as fast as we did over that 2.5 year period, I think things are going rather well. And yes, you know, mortgage applications have slowed down dramatically, understandably, right? I mean, you've literally raised mortgage payments by probably 75% on a single family home, for the same amount of money, right? If you're borrowing $250,000, $300,000, I'm sure the mortgage payments have gone up by 50 to 75%. So of course, yes, you're going to have that that slight pullback. But interest rates, in my opinion, aren't actually as high as people think they are, right? I'm sure your parents and my parents have preached to you over the years that in the late 70s, early 80s, when they were looking for things, they were in the double digits in terms of interest rates. My parents' first house, they had to do, you know, this was 78, 79. They had to do owner financing, seller financing, because interest rates at the bank would have been 18%. And so in that particular case, like, shit's cheap right now comparatively to then. So to me, I don't know. I think we're still used to the zero interest rate policy that we've been on for the past 10 to 15 years. And we're still working out the fact that these are actually normal interest rates.
No, but the challenge is, though, Matt, in the 1980s and 70s, we did not have a debt to GDP that was 122%. You know, our debt to GDP wasn't high at the time. So you could raise rates and it would impact consumers, but it wouldn't cost you to basically spiral out of control with regards to your budget. You know, the government wouldn't go out of business. Like right now, I mean, I wouldn't say we're going to go out of business, but we're in a debt spiral that's way different than what it was before. Like I said, if right now, let's say the national debt was 10 trillion, right? And you raise rates to even 10%, like the federal funds rate, let's say it was 10% to really quash inflation, it wouldn't matter, because it's like, oh, you know what? We don't have a huge amount of debt on the balance sheet that we have to worry about. But right now, if you look at the amount of interest that we're paying on the debt relative to our GDP, it's just significant, you know, and that's the problem that you have, that you've created a problem where you've borrowed too much. And now that interest rates are going up even slightly, they're causing pain. Now, of course, there's solutions to it. The government always has solutions to it. That's the beauty of like the monetary system that we have. But I mean, even when you look at the just general economy, let me just share some statistics that kind of like show where we are right now. Okay. So first and foremost, employment and wages, right? So if you look at the number of job openings that we've had through JOLTS, job openings have been coming down significantly since 2022. And so they're literally back at 2019 levels again, right? So the number of jobs continues to keep crawling lower and lower. Yeah, there's points where things go up and down because of seasonality, but for the most part, the direction is one way and it's going down, right? If you look at
But can
long
I ask a
term,
question? Wouldn't that be
yeah.
more of a reversion to the mean, though, rather than because obviously after the pandemic, there's going to be lots of job openings. You're going to have this place where you're kind of looking for a lot more people to be employed. As you can see, I mean, it was kind of a
Mhm.
reversion back to where we were pre-pandemic.
Well, see, the challenge isn't that we're getting back to the mean. It's the question of, is it going to stop at this level? That's the challenge. Like when things are moving in a certain direction, it's really hard to kind of pivot away and go like a nice U shape this way, especially when interest rates are higher. Interest rates are high, capital spending from businesses lower because they can't afford to spend more money without incurring a crap ton of debt. If you have a crap ton of debt, now more of your profits are going towards servicing debt rather than hiring people, you know? So, and at the same time, if you're tapping the consumer, you're also going to have less consumers be able to buy your product. So you're theoretically slowing the economy down and you're slowing down demand. Not to mention, when you think about employment, AI hasn't even fully gone into effect yet, right? So we could see a ton of AI start coming in and replacing a lot of jobs. Like here's an example, like Microsoft, most profitable company on planet right now, right? They still did 3,000 layoffs of people, so there's a wave of unemployment, and the thing is, like, we have to theoretically slow this down. Yes, it's reverting back to the mean and it's at 2019 levels, but the question is, how much further is it going to keep going down before it kind of levels off a little bit, right? So this is something to just pay attention to. There are some other key data points that let me just highlight, and then we can discuss them. Another one, of course, is longer term unemployment. This is for people that have lost their jobs and they cannot find another one for whatever reason. That is starting to creep up, and that's at 2019 levels again.
It's like
Okay.
18, 24 months or something like that. You've been on
Yeah,
unemployment for like 18, 24 months, something like that.
exactly. So, so once again, these people are relying on government programs and everything else. But at the same time, if they can't find another job, they just keep getting higher and higher. This level keeps going up. That's not good either. Youth unemployment is over 2019 levels. This is like the younger crowd looking for jobs and everything else. So that's trending up, right? If you look at our unemployment, the one good thing is that our unemployment is below 5%. I think at 5%, no matter what happens, the Federal Reserve has to act, because at that point, they're risking the general economy. Right now, it's at 4.2, but it has been trending higher, right? It's leveling off a little bit, but it's trending higher and in the wrong direction. The higher the interest rates and the longer they keep up, I think this number keeps growing. Right now, with this tariff situation, we've got two things. We've got lower oil prices, which means that the oil patch is definitely going to face some struggles there, and you're going to see some unemployment there, and that should raise a little bit up here. Then you've got, of course, AI, which is going to raise unemployment at the services level just a little bit. I don't know how that's going to impact it 5 years from now, but at least in the short term, that's definitely going to have an impact. And then you have construction. Like there's a lot of jobs that are in construction. Commercial real estate is dead. They're not really building too many office buildings anymore because we've got an oversupply. Now you've got 6-7% rates on houses. New housing building is gone down the drain. So now you've got all of these people who are building houses. They're going to be on unemployment, right? So those are just two things. And then of course you've got truck drivers and everything else with the tariffs. All these people work in logistics. So if those logistics jobs come on the market because of a slowing economy, because of less demand, everything else, you've got more unemployment. So unemployment is once again ticking higher right now. And one of the reasons why is because high interest rates. If you look at wage growth, this is actually something to be even more concerned about, because if you look at wage growth, it usually is between 3 and I would say 4%, depending on how the economy is doing. But the reason for that is if you have inflation growing at, let's say, 2.5% or 3%, and nominal wages are growing by 3%, that means the worker is not actually gaining any money. All you're doing is just paying people for inflation, and that job is staying the same. The challenge that we have now is that it's actually gone below 4%. So wage, like the amount of money that workers can demand in terms of wage growth is going down. If your wages are going down, but inflation is staying up, that means your real buying power is actually going down, which means as a consumer, you're weakening. So if you look at people right now, if you're, let's say you're trying to buy a house, the cost of buying a house for you it's significantly higher than what it was for someone who literally bought 3 years ago. So there's distortions that are also being created. But the one thing, once again, wage growth is starting to come down significantly. If you look at delinquent,
with all these issues, I mean, you're about to bring up student loan debt coming back and etc. And Doug, I saw Dougie in the chat. I know he has some prime words associated with that, and as do I. With all these trends that you're seeing, you see them slowly creep up since 2022. 2022 being the pivot point at which we started raising interest rates again. With this administration, I know you've been somewhat critical of some of the things that have been going on. I'm not 100% of a fan of everything that's been going on either, but I'm generally in favor of what I've been seeing. Do you think that you're going to see a large pivot in terms of unemployment, a large pivot in terms of the long-term unemployed folks, the deficit of people being delinquent on things go up and to the right at an exponential pace, or do you think we're just going to continue along the trend lines that have been established since 2022? And so when are you seeing like a large wave of these things happening? Is it going to be in the next couple months? Is it going to be in 6 months? Is it going to be a year?
See, the challenge that you run into is that structurally something has to break in order to cause this massive trigger that gets pulled, right? So I think what it is everything happens in a slow pace, but then there's a trigger that happens and causes huge problems to come up. Like if you look at auto loans right now, right? Like auto loans, their delinquency rates are starting to come up. Credit cards are higher than what they were pre-pandemic. You've got student loans coming in. You've got mortgages that are starting to come in, like delinquencies are starting to come back because a lot of the protections that they had with during the pandemic, some people weren't even paying their mortgages. Literally, it was like the Fannie and Freddie would just take your non-payment, put it to the back of your loan, and do these modifications. So there's all sorts of distortions that happened during COVID that left a lot of consumers with money in their pockets, and that money was out there being spent to the general economy. The thing is, a lot of those things are starting to come back, and they're biting people in the butt right now during the wrong time. Now, the thing is, these tariffs, they've essentially caused this market uncertainty. And the thing is, we could have been in this nice, recovery. What is it called? Like the soft landing scenario, but the soft landing is becoming a bigger problem than what was originally forecasted. But like I said, the key here is, a lot of people are saying, well, the consumer is healthy. The consumer is fine. And my theory is the consumer is not fine. The consumer is actually starting to buckle a little bit. And a lot of the policies that the administration are coming up with right now, they seem to be there to hit the consumer over the head. And maybe that's the way that they're going to get inflation down below that 2% target. And maybe that's the ultimate goal. But, as far as I can tell, I don't know. It's just it's hard to see. Then you've got, of course, changes to people's credit scores, the number of people that are basically going to be impacted because of, they're not paying their student loans and the delinquency rates are there. All of those people are going into collections now. Car repossessions are at all-time highs. Well, not all time, but sorry, Great Recession level highs again. So basically, if you look at the borrowers, the prime borrowers, people who have good credit, they don't have nearly the amount of defaults. But subprime people, these are people who got car loans probably during COVID. Their default rates are almost at 6.6%. All of these cars are coming on to dealer lots. Anecdotally, from what I've heard, some of these repo dealers, basically being brought back, they're not even accepting cars below a certain model year because they're inundated with how many cars that they have. You know, delinquencies are starting to surge on the credit card side. Like, you're starting to see the buckling of the of the economy right now when it comes to rentals, right? The number of like rental vacancy in the United States, like of housing, is back to pre-pandemic levels, and it's just literally surging higher and higher. Okay, that means a lot more homes are sitting vacant right now compared to what they were in 2019. You know, then you look at values like rents are falling. I don't know if you've seen this in your area, but according to Zillow, newer rental listings are actually coming down significantly. Have you seen that on your side?
Well, I haven't been looking for rentals. I've been listing rentals
Mm.
and haven't had such an impact yet. But as you're kind of seeing, it's more of a peak that we're seeing right now, rather than kind of a we're just coming off the peak rather than really starting to be in a deep slump of it. Um, I don't know. I personally haven't seen anything. I'm actually kind of curious. My buddy was looking for a place in Nashville, and I was chatting with him, and things seem
Mm.
pretty strong in Nashville. I probably should take a look as to what rents are going for
I
in
mean,
my
we could take a
area,
look.
specifically, kind of behind me. I have a nice rental apartment building, and eventually, I plan to rent this house out that I'm living in at the moment.
Yeah,
Um, so as I find another home to potentially move into, more of a forever home. But
yeah.
yeah, I'd
I
be
mean,
curious.
look at this. In May of last year, you were looking at about 2,100. Now it's like 1,843. I mean, I'm going to take this data with a grain of salt, but available rentals almost 760,000 apartments or whatever available to rent. I mean, and
Can
we
you
could
look
look.
specifically for Houston or
Yeah, yeah, yeah. You can actually choose an area. Houston, Texas. There you go. May, it's come down significantly,
hmm,
about almost $200 compared to last year. I wonder. This is the thing that I was trying to figure out, like why this has come down so much. I wonder if there's any structural changes because it's happened in a lot of areas. Like let me Atlanta, because I've seen this specifically. Like we have a lot of vacancies here, and they're coming down significantly. Like so if you even just go to rent Atlanta, like look at this. This is how many rentals are available in this area. It's like literally dotted because we had a lot of buildings that were being built, and you can see here. Look at this. Literally building after building, and vacancy rates are super high. I mean, if you want to look in Houston, we can take a look there too.
yeah, feel free. I mean, I think
Yeah.
also though, you'll see people that each one of those could be an apartment building with one unit, right? And you'll see
Mhm.
some that say 17 units, 15 units, whatever. But
Yeah.
you know,
Yeah. Like
one,
this one's got 36 units, you
yeah.
know. Yeah. Look at this.
But I think they list a lot of those, right? Like they either brand new buildings or they list everything, and they'll be like, "Oh yeah, like if you're interested, but you'll be on a wait list for however long as well, like waiting for that
Yeah.
particular apartment to show up."
I mean,
Um,
as far as I can tell, anecdotally, once again, I've seen a lot of what is they called? Like rentals come on the market, but a lot of them are doing this like special deal where it's like you get 3 months of rent for free or 2 months of rent for free, but your rent is like, like $1,800. And the way that the reason why they do that is because when they go for these refinancing loans, right? They're they're basically like saying, look, all my tenants are paying 2,400, so my annual income is 24, 20, 240,000. So my loan should be based on that, that income. So that's like one way to game the system when technically they're not really paying 2,400, they're all paying 2,000, because technically you gave them 3 months rent for free. You see how you can game the thing, and they always keep refreshing. I don't know. There's a lot of
it's
things.
also, I mean, commercial real estate is all based off the income that you generate, right? So it also helps build in your first annual renewal, and
Mhm.
the increase there, right? Because that was something that I've gotten as well. When I moved back to the States in 2020 and I was literally homeless because I literally packed up and moved out of the country and had to move back into the country because of the pandemic. They gave me that same spiel, right? I think the apartment, I'll just be blunt, I think it was supposed to be 2,700 or 2,800 a month or whatever like that, but they gave me 3 or months free, and it ended up being like 2,100 or something. And they pulled the same thing next year. They were like, your rent's going to go up. And I said, try me, I'll effing leave, right? And they said, okay, we'll give you 3 months more free. They had a bunch of people move out of the building. And so I was able to keep that up for a year or two. And then basically until I bought this house back in 2023, they were trying to pull the same thing. And I was like, you're going to give me 3 months free or I'll leave. And they said no. And I said, okay, well, I'm leaving. And so, yeah, I mean, that's the game, right? Is that they always try to pull that, because it would have went from 2,100 to 2,700, right? And think about how much more appeasing having an apartment full of 100 units going at 2,100 versus 2,700 on a monthly basis. I mean, the cap rate would probably stay the same, 5-6% on the entirety of the building. And so if you're able to raise everybody's rent by $700, which in that case is 30%, the value of that building is immediately increases by 30%. Because everything goes off of cap rate. So it's unlike single family residences where it doesn't matter if you raise the rent $250, $300. If you live in a single family home, it's going to be based off of what the comps in the area sell for a 3-bed, 2.5 bath. So, if you have a prime piece of real estate and you literally have a trailing 12 month of, let's say, a couple $1,000,000, and you're able to increase it by 500,000, you're able to take that $500,000 increase and multiply it by 20. And be able to get an additional $10 million worth of value out of the building. So anyway, that's how the rental game works. If people haven't really,
but that's the thing. Like, there's so many shady ways that people are gaming the system, and I think sometimes the banks are willfully, letting it happen as well, where they're like, oh well, you're getting this much, but I don't know. Sometimes the system's set up where it's almost like don't ask, don't tell. The banks had that during the subprime days, because most of the mortgages were being bought by Fannie and Freddie. So it was like, oh, whatever, it's all good. We could just, let things go. So I don't know. We'll see what happens. Well, we're just at a point right now where I think a lot of people are thinking that the economy and the consumer is strong. And from what I can see, the top 25% of earners are doing really well. It's the bottom 75 that are really hurting right now. The bottom 75, they rent. They don't own assets. They don't have stocks. They don't have bonds. They don't have a portfolio of assets that's generating more income to supplement, bad times. So those people are in a world of hurt. Then there's other people that are sitting in, like, let's say you have a paid off house. You're doing really well, because even if, let's say, you were working the same job as someone making 50,000 versus someone who's, has a paid off house, the guy who has 50,000, that's making 50 grand a year, he has to basically come up with $2,200 to pay that, housing and fixed income costs, that fixed cost. The guy who owns the house has to come up with maybe 500 or less to pay for property taxes and all this other stuff. So that's one area where it's like the people who hold the actual assets, they're in a much better position. So they have more disposable income than someone who doesn't. Like, just imagine you right now. Like, if you were sitting on a $600,000 house you bought 5 years ago, it's not even that long ago, 5 years ago. And at the same time, you got like a 2.7 or a 3% mortgage and you're paying a certain amount, versus someone else right now looking to buy a house, and they have to pay 7 or 8%. And the new home prices, which are almost, I don't know, double of what they were in certain areas. I'd probably say, let's say, 60% higher, 70% higher. They're in a much worse state because now they have to climb over a much bigger hurdle just to get to that same level as that guy was before. So that's why one of the things I noticed yesterday, me and the wife, we went to drop off my brother-in-law at the airport. And we were driving from Atlanta Airport. I don't know if you know where Atlanta Airport is. It's like a really, really shady part of Atlanta. And as you drive up and you start moving up, you start to see like the huge difference
Mm.
in like the quality of life of the people. So if you go like, to where the airport is, it's literally, you see shanties, you see terrible houses, you see people just hanging around. And then as you move up, you start to see more like middle class people. And then like you get to Buckhead, and that's where you see like the driveways with a bunch of Benzes and like Porsches and stuff like that. And then you go, and then you keep going up, and you just keep seeing the wealth happen. And the thing is, wealth, once you build wealth, it's awesome, because now most of your basic needs are 100% completely taken care of. So there's no stress on you, and any additional increment that money generates, you're basically living a much, much better life versus someone who's literally at the bottom trying to just basically survive, dude.
I mean, there are those people, but I also think that the majority of people in this world, especially Americans, don't actually plan appropriately, right? I didn't magically get wealthy overnight, right?
No, of course, of course.
It took
Yeah.
10 years. And also I studied my ass off in college to be able to get a good degree where I came out of college, So I think a lot of people, they don't want to put in that work. They don't want to think smart. They'd rather, figure it out the next day, kick the can down the road. And I think that's just the American way, right? I think if you think about it, that's kind of what the US government does. You have to think things through, think methodically, be able to put a plan in place and kind of delay gratification. And over time, you get to a place where you're able to grow your portfolio by a couple $100,000 in a year, right? Because you've been able to establish a base enough. $500 used to be a lot of money to me 10, 15 years ago. Now it's, a drop in the bucket. But it took me having to scavenge and save $500 a month. And I know there's going to be these people that unfortunately can't, right? They've dug themselves in a bind. But the hope is before you go in this downward spiral, that you're able to plan appropriately, get yourself in the right course of mind. Like I see so many American families that literally get an Amazon package delivered every single day. And I'm assuming that the value of that Amazon package is probably 20 to 30 bucks, right? And if you're able to do that, and you were actually instead don't do that, right? Of course, you have the necessities, you have the daily things. I get that. But I'm just going to be honest. I've seen a lot of people that get the stupidest shit, and their focus is on buying something on Amazon or Target every day for $20, $30. At the end of the month, that's $500 that they could be saving in their investment account. You might say, oh, that's $6,000. It's not a lot. Well, do that for a couple of years. Next thing you know, you got 50 grand, right? It's not rocket science. And I think a lot of people just say, oh, woe is me. But imagine if you have 50 grand in your pocket right now, right? I mean, the amount of relief that can have on any American is phenomenal. And so I just think that a lot of times, yes, we like to say that the government is against us, the world is against us. It's like, but I think the majority of the times, the people that are against you are the people that are looking across you in the mirror, which is yourself.
No, I totally agree with you. Trust me, I've been in the same shoes. Like when I was growing up, bro, I was broke as hell. Okay. Like I did not have money. I worked my way to where I am today. All right. But I am 100%, I can tell you that these days it's getting harder and harder to get to that level where you can work. I'm not saying it's not achievable. Trust me, if you've got the willpower, you can do anything. Like this country is built on people who can actually like put in the work ethic. Like if you've got a good work ethic, you'll succeed. But the thing is that work ethic that's required seems to be getting higher and higher by the day, So I'm not saying, I'm with you that there is a lot of people who are more into material consumption than they are with saving and, investing and doing everything else. And trust me, this whole channel is built on the idea that if you don't spend money and you take that money, you spend, you buy stock like Venture Global, you'll do well eventually, or the companies that we have in our portfolio. But the point is, you have to get to that level where you're actually saving some money, right? That's the problem with the average consumer. That some of these people have become so I don't want to say coddled, but one of the biggest disservices that I've seen happen, and this is just me being a Republican. I'm going to put my Republican hat for 2 seconds. I feel like You don't have food? Here's food stamps. You don't have a place to live? Here's Section 8 housing. Oh, you don't have health insurance? Here's Medicaid. Like, you've basically taken every incentive for this person to get beyond that. And so what do they have now? They have their shitty little apartment sitting, watching TV or Netflix um, and basically playing video games. Like, how many people I know that are in my age group that are like that in my distant family, they don't have a job. They're like, whatever, like I'll figure it out here and there. And they're living on the bare minimum. But then the reason why they're on that bare minimum is because there's all these social programs. So there's no incentive for them to go do anything. So even right now, like you're seeing this in Congress where they want to put some work requirements on Medicaid and there's pushback. And I know there's genuinely people who cannot actually work, but then there's also people that are gaming the system. And instead of trying to figure out like, hey, let's get these people off the dole and get them into the workforce and actually use personal responsibility. It's like, let me show you this one video. I think we also, I hold on one second. I don't know what to search for to find it, but it was,
I'm not saying it's easy, but guys, I'm just saying it doesn't happen overnight, and you really have to put some forethought into it. And something as simple as, and I see a lot of people like, and this goes for everybody. Something as simple as, oh, my company has set up a 401k, so I trust that they did the right thing. They probably fucking didn't, right? They probably put it in a target date fund that's literally robbing you of fees. I literally dealt with somebody 2 weeks ago that did just that. And just in the 2 to 3 years that they worked at this particular office, they lost out on $2,000 to $3,000 worth of gains, right? They were pissed off just with the fact of that. But I know people that have been doing it for 20 years and have been in these target date funds that's literally robbing them. And a lot of people argue like, well, target date funds, they automatically allocate things for you and everything like. It's like, how many people have their hands in your pocket when you do a target date fund? It's literally like 3 or 4 different investment companies that are trying to charge you investment advisory fees out the wazoo, and you end up underperforming the S&P 500 by 4 or 5% per annum. And that's exactly what happened to my buddy 2 weeks ago. He called me up. He's like, hey, I know you told me to check this. I'm just getting around to it a year later. And, let's walk through it. He shared his screen. I said, don't do that. Let's just take a look. And it showed verbatim that he had lost $2,000 to $3,000 in opportunity cost by not investing in something as simple as an S&P 500. And I guarantee that half the people in here that are in the chat have yet to look at it. And I hear trickles of something like, this will trigger somebody in 2 to 3 years messaging me or DMing me because it's inevitable. It's like clockwork. Every 3 to 6 months, because I mentioned it, every 3 to 6 months, I'll get another tranche of people that say, I can't believe you saved me. And I'm so pissed at myself because I missed out on tens of thousands of dollars. So here you go. This is another little if of like, I'm leading you to the water. You just have to drink it. But it's really sad, and it's small things like that. It's not just that, right? It's other things like saving that 15% every month, and people won't do it. And then they get 20, 30 years down the road, and they're like, I can't believe I haven't been saving this much, and now I have to save 30% to even make things get even close to where I want them to be.
Yeah. All right, whatever. Let's just take a quick look at our portfolio if you have it loaded up, see where we are. And then after that, let's look at some expectations that we have going forward for the rest of the year. This is the kind of market, man, I hate, because it's always like you have to look at policy, and every other day it's like new policy dictates how the market's going to end up moving right and left. It's a pain in the ass, but whatever.
This is the portfolio. Just to give everybody a quick rundown, this is where we were 10 days ago. $7,200 on the entirety of the portfolio. So massive increase, about $500. We didn't add any capital because we haven't been doing as many streams as of late. So we actually didn't get a payout at the beginning of May. So hopefully by June timeframe, we have enough to be able to get a payout. So that'd be good. We'll add that to the coffers, but it's nice to see. I mean, you just look at the difference between these two graphics. Had some massive increases. Norwegian, the cruise lines have come back a good bit. HIMS has come back a good bit. Venture Global up about 5% since then. So overall, just looking pretty healthy. We were down 8% literally 10 days ago, and now we're down less than 1% overall on all of our investments, with Accelera leading the way in terms of total loss, but obviously on a total value basis, not that big of a deal. But Venture Global being the one that we are trying to lower that cost basis, and hopefully we'll be able to knock that out once we get a couple years down the road. Another nice one, Bitcoin, been doing rather well with that one, up 40%. And so hopefully with Bitcoin performance opening up tomorrow, we'll hopefully see that climb closer to 50%, and that'll continue to do well with that. SMCI surprised that we're back above $40, but there's that one. What else is there? New, I'm happy that's above 13. I have a pretty decent new position personally in options, not equity. But yeah, where do you think we are, Mr. Patel, in terms of year-to-date return and then the past year's performance return? You're on mute.
Maybe we're down about 10% for the year.
For the year? And what about the last 12 months?
I don't know. I really don't know. I couldn't guess.
Yeah, no worries. So on the left, you have year-to-date performance. We're down 4%. So we're dragging behind the S&P by about 6%, and that is as of Friday. So we have some room to catch up, but we are still out competing on a 12-month basis. The S&P by, what is that? I'm not good with math, Chris. 22 percentage points or so. 23 percentage points.
We're staying. We're not at that 3x target. Like if we can perform 3x S&P, we're like out competing against pretty much every fund manager out there. So we're not nearly there, but we'll get there. We'll get there.
I think that the way that we structure our portfolio, and it's very much how I structure my portfolio as well, personally, it goes kind of back to investing in things that aren't going to be matching the S&P 500. So the beta of those things might be a little bit not correlated. So like things like Venture Global obviously have taken a large impact.
Yeah.
Recent IPO in January, and now we're starting to hit some sort of baseline and actually revert back to probably what it should have been priced at, which is probably the $15 range. Mm-hmm. So we'll hopefully see that continue up and to the right. But you also have things that are meant to kind of stay flat and pay a dividend, right? So you have BPYPN. Actually, I didn't realize our Rocket Lab position had gotten so big as well, but I forgot that we had bought into that. And I think you asked me to buy into AST, but I never did. So we can discuss that as well. But glad I held on to Celsius. I made a pretty penny on Celsius in my personal portfolio when that popped up after the Alani news. So, and I know there was an opportunity where it dipped back below the low 30s again with the pullback in April. Wished I added more, but when you don't have capital to add, it's kind of tough to continue to add to the portfolio unless you're adjusting things. I really wish we didn't trim HIMS as much as we did, because that would have pulled us up a good bit. I think we trimmed HIMS 2 or 3 times already.
Yeah. Yes, sir. So that's where we are with the portfolio. So I think right now we're at a point where, I don't know. I'm just gonna be blunt and just say it. I'm a little bit worried about the market again. I think we're getting back to greed levels, on the fear and greed index. We're getting to high levels again. And this rally has been led by a lot of retail. Just when institutions were dumping, retail was just out there buying right and left. And the Trump administration came out and said, you should be buying stocks. So I think a lot of people got caught flat-footed. And I think structurally positioning wise, this is where you should be somewhat more reserved when it comes to adding new capital into things and maybe hedging a little bit. I know that you don't like the word, your hedges just hold, like buy and hold. I'm not, I like hedging a little bit. I'm at the point right now where I told you I bought into some TLT spreads. I think if the economy really goes to shit, Jerome Powell's really not going to have a choice but to cut. And, the triggers are there. So makes sense to me.
Yeah, if you asked me 3 weeks ago, 4 weeks ago, my thought would have been, don't hold a lot of cash here. Add, buy the dip, and really kind of pull it full. But I agree with you, and I've had a good chat with Amit on the stock market close on Friday, and said I think we ran up a little bit further than I was expecting, 5,900 on the SPY, and I still think that like you stated, there's another foot to drop with respect to tariffs and revisiting that. Right, we never fully came to a conclusion. It was a 90-day pause for a lot of these opportunities. So we still haven't gotten to the place where we've signed deals, although we've made great progress. And I think that what we saw, which is 4,800, 4,850 on the S&P, was overblown. I don't think it fully warrants us going back to all-time highs at 6,100 on the S&P 500 either. So I told Amit I was kind of really expecting us to hang out in the 5,700, 5,600 on the SPY. And we're obviously 200, 250 points above that right now. So I'm with you. I think I wouldn't be surprised if we see a retracement and pull back a little bit. But I guess it always goes back to, what are you looking at? I still think the economy is in a good position, and for now, I do see some cracks, as you're well putting, Chris. I'm not downvaluing those at all. I agree with you. I just feel like with potentially things continuing, business tax cuts potentially coming through the later half of this year, some reducing of the interest rates, inflation coming down, that hopefully a lot of those negative trends begin to plateau. But I can fully understand where you're coming with respect to tariffs, putting more pressure potentially on the consumer, and obviously increasing inflation again, and reversing some of those good trends that we've had in inflation over the past 2 years, since we peaked out at 9.5, 11%, whatever you want to call it. So I'm more than happy to stay on, talk about VG, but we are competing now with our good friend Amit. He went live about 15 minutes ago, and we've been losing people ever since. So by no means am I trying to keep you on forever, but at the same time, I don't want to detract away from him. You're on mute.
I'll just say one thing. I would say the market, once again, we have to go back to fundamentals. The market hates uncertainty. So some of the messaging that happened this weekend and last week shows, once again, that we're back to being, somewhat in the zone of uncertainty. Whether that's by design by the administration or not, I can't say for certain. But I would say that, once again, valuations are, something to watch out for, and there's definitely going to be multiple compression. So I would not be surprised if, I'm not saying that we're going to retest the lows again, like some of the, like the major investors that are out there. They're thinking like, hey, we're going to get back to the lows again. And if we do have a fight in Congress with regards to the budget, and we get close to that debt ceiling limit and all the other stuff that happens around that, we could very well get into that position again. I don't think that we're anywhere near that. I think, Congress will figure things out. But let's just say right now is not a time to be a hero. Right now is a time to just chill. And when things really sell off, make sure you have the capital and the cash to deploy and basically, buy these great companies at cheap prices. So,
and buy Bitcoin.
Damn Bitcoin, bro. Damn Bitcoin.
You buying any or what?
Nah, I'm good, bro.
What if it's 1%? Just every
no,
month. No, not
no.
getting convinced you 1%.
No, I'm good. How much Bitcoin do you have? You can tell me offline. You don't have to tell me. Yeah, you do. I know.
I stopped sharing a lot of that stuff in 2022, man. Yeah.
Yeah. You just bought through GBTC, right?
Initially, I bought just through GBTC back in 2020, and a few, and then now I've been buying through BTC, which is
Mhm.
the lower expense ratio one. If I sell any puts or do anything like that, I do it through IBIT because
Mhm.
it's more liquid. So I still have a GBTC position because obviously it doesn't make sense to sell it because, as people have been following, Bitcoin is up a lot since 2020. So do I want to pay that tax bill? The answer is no.
Yeah.
And hopefully over time they'll continue to lower the expense ratio. And then BTC is what I add to pretty regularly, but I also buy actual Bitcoin twice a month. I
Okay.
actually buy physical Bitcoin and offload it to a wallet that's kind of in cold storage. So um, yeah, I mean, I'm trying to get to a little bit more. I would love to have double the amount that I have, but now that the price has obviously gone up 10x from when I started buying, it's maybe even more so, maybe even 15x since when I started buying. It's a little bit more difficult. I will say, as always with everything, I always regret not buying more, being scared, um, not having the confidence in myself and conviction. So
Mhm.
I've experienced that with Palantir now.
Hmm.
Even though I have a massive position in Palantir,
Yeah.
comparatively to some, I didn't buy enough of that when and in retrospect, I wish I bought more. Same thing with Rocket Lab. Although I don't feel as bad with Rocket Lab because I said to myself, I want to get $100,000 of my own capital invested, and at the time
Mhm.
that was a lot of money, and so um, I don't feel as bad about that. But Bitcoin, I really pussyfooted around. Pardon my, just crude language there, but it's the truth. Like I should have just been like, you know what? I believe in this thing. Let me buy a couple coins on the cheap, and I never did. And I still am doing okay. It'll help over time. I'm convinced it'll be able to be used as a bank for me. The Bitcoin position that I do have, but unfortunately, I should have literally just been like, you know what? I made 20 whatever $1,000 in this bonus for the year. Let me just use half of it to buy Bitcoin. And
Yeah.
instead I
It's
bought
at
other stock.
107. It's at 107 now.
Yeah. So, but I'm now, and I've had this conversation. I have a guy who I literally shout out if he's, I haven't seen him here today. I don't think he follows the Cashflow Chronicles. He definitely follows my personal channel, but I get lunch with him every other month or so. And I don't want to say how much he has, but he has all of his net worth pretty much into it. And then he has
Mhm.
some micro strategy, and I think that's pretty much it. And so that's all he does is he has that, and he's trying to um, play basically the game, and he's looking to potentially sell out when it gets a little peaky, just so he can get a little bit more. He's not going to
Yeah,
sell
yeah,
out forever, but he's going to potentially hedge and try to buy back a little bit better so he can get 10-15% more on the way
yeah.
down. So anyway, there's some people out there that are really into it, and he told me, he was like, you're doing 2% a month of whatever salary I get. I said, yep, 2%. He's like, I bet every month you think that that's not enough, don't you? And I say, yeah. It started out at 0.5%, then I went to 1%, then I went to 2%, and I don't notice it. That's the thing. It's like I don't know. Like I'm not sitting there being like I don't have enough money. So it's like if
Mhm.
I could, why don't I try to put 3%, 4% every single month away? And I know in the long term it'll be beneficial.
I mean, it's proven to be a hedge against inflation, right? So I think right now, inflation, the US dollar, and I think this is the one thing I think Saylor got right in saying that the government's always going to print more dollars. There's no printing of more Bitcoin, you know? And now there's enough people to turn Bitcoin into a religion that basically, people will keep buying it. And I don't think there's going to be a point where this thing stops. At least I don't see it. I think there's enough people that are always deploying more and more capital into Bitcoin to keep the prices going higher and higher. And at the same time, the fiat currency just keeps devaluing itself. So, in relative, when you think about it from like a relative perspective, Bitcoin's not a bad place to be. So,
Yeah. You
yeah.
don't think it's a scam like you did, a year or 2 years ago?
I still think it's a scam. I think one day Satoshi Nakamoto comes out and says, "Ha ha! I think the biggest challenge with Bitcoin is policy and administrative changes. Like right now, there seems to be enough governments that are kind of like Bitcoin is like a nuisance and it's fine. But ultimately, if Bitcoin challenges the status quo in fiat currency, then then it could definitely like hinder its progress. So right now, under the Trump administration, who's wholeheartedly embraced cryptocurrency, if let's say an administration comes in that's more like stringent on policies around crypto, then you could see, some level of correction here and there. But yeah, I don't know. I don't know if that's even a possibility now.
You can easily account for 7.5% of the Bitcoin.
Say that again?
And you can easily account for 7.5%. I'm not counting Satoshis. I'm counting for MicroStrategy owning about 500,000. The U.S. government holding, about the same. And then the Bitcoin ETFs accounting for about the same. So that's about 7.5%. I think Satoshi had like 2 million, so that's 10%. So right there, you can account for 17.5% of all the Bitcoin. And, I don't own 1% or anything like that, but, it's, you start to think about it. It's like there's pretty few and far between. It's borderless. And I think that's a huge piece of it, because at the moment, you still have to, regardless of how globalized the world economy has become, you still have to use some sort of antiquated government currency, which is a blessing and a curse, right? Because you have to have some sort of backing of any sort of currency. But I think you've come up with a decent system, being in Bitcoin, where, like you stated, there's no inflationary aspect of it. It's, literally limited to 21 million. And in that respect, because you have inflation going on in all these other currencies, it'll always seem like you're making money in that respect.
Yeah. All right, brother. Have a good one. I'll see you.
Good to see you. We'll have to have another one about VG, because we didn't get to it.
Yeah, we'll get to it eventually, guys. Sorry.
Cool. Yeah.
Later.
Talk to you in a bit, brother.
Bye.
Bye.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.